I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading tight bear channels. I want to begin by defining what I mean by a tight bear channel. Whenever it's difficult to make money buying and the market's in a bear trend, you should only be looking to sell. A tight bear channel is a breakout on the next higher time frame chart, and you should only be selling when the market's in a bear breakout. When a bear trend is in a tight bear channel, there are sometimes pullbacks, reversal attempts that are small, tight bull channels. Those small, tight bull channels lasting 2, 3, 5 bars are small bear flags, and the market usually continues down. However, if the pullback becomes an endless pullback and it grows to 10 or 20 bars, it might actually lead to a bull breakout of the bear flag and a bull trend. Channels are either relatively tight or relatively broad, and it's important to distinguish the two because you trade them differently. When it's very tight, you only trade in the direction of the trend, you sell. When a channel is relatively broad, bulls will buy in addition to the bears selling. You do not have to buy, but you definitely need to be selling because the market's in a bear trend. Tight bear channel, whenever a channel looks like this, I'll describe the features in a minute, it's tight. And you should trade it like a tight bear channel, which means you trade it like a strong breakout and you only trade in the direction of the trend. You only sell. You sell for any reason. You sell below bars, you sell above bars, you sell breakouts, you sell near the top of the channel, you sell a 50% retracement of the prior leg. You just have to be selling for any reason. Nobody's going to take all of these shorts, but you have to take at least one when the channel looks like this. Now compare this channel with this channel. The bears are going to be selling, especially in the middle third of the prior bear leg. So somewhere in here, bear leg, they'll sell in the middle third. So the bears are going to be selling, but the swings up are big enough for the bulls to make money scalping. And therefore, bulls will buy. At least some bulls will buy. Bulls will buy for scalps. Bears will sell either for swings or for scalps. But because it's a bear trend, you need to be selling. Channel broad relative to this. This is very tight. Bears will sell pullbacks and look for resumption down and a new low. They can sell below bars. They can sell above bars, like above this bear bar. Here's a low too short, small double top. Again, 2 legs up, 1 pullback 2, good bear bar. A lower high, so it's still a bear channel. Lower high here, so still a bear channel. This is a minor lower high because this leg is not a strong leg down. This is a minor lower high because the leg down from it did not make a new low. It's a reasonably strong breakout, but it did not make a new low. It has a higher low, and therefore the market may go above this high. As long as it's making major lower highs like here, and the pullbacks are not going above, it's still in a broad bear channel, and traders should look to sell. 5-minute chart of the euro versus the dollar. Again, the reason why I like to distinguish tight from broad channels is I trade them differently. When a channel is tight like this, I only want to sell because it's virtually impossible to make money buying. You might make money 1 or 2 times, but the other times you'll lose and your losses will be greater than your wins. Again, when a channel is broad, you can make money buying or selling, but because it's a bear trend, it's always better to be trying to sell. Very tight channel. Very difficult to make money buying. Even buying with limit orders at new lows and scaling in lower. Very difficult to make money. The pullbacks do not go up far enough to allow you to make a profit. Let me talk about some of the features that I use to help me decide whether a channel is broad or tight. One is the pullbacks only last 1, 2, or 3 bars. Here, this bar went above that bar, so it's a 1-bar pullback. And then this bar went above that bar. It's a 2-bar pullback. And if the pullbacks last more, the pullback bars are small and they fail to get above the most recent lower high. The size of the pullbacks, from the bottom of the pullback to the top of the pullback. In this particular trend, the biggest pullback is only 20 pips. In general, traders should not be looking to buy unless he starts to see pullbacks that are 30 pips or more. You want them to be at least 2 to 3 times as big as the smallest scalp. And when you're trading in the Forex markets, the smallest scalp is 10 pips. You need pullbacks usually 30 pips or higher before you can start buying. I also look at the size of an average bar. In this particular trend, the average bar is 10 pips or less, and I don't want to be buying unless the pullback is at least 2 to 3 times bigger than the average bar. Otherwise, it's very difficult to make money buying. I also look at the size of the pullback relative to the most recent bear leg. Here's a bear leg, and the pullback retraces a little bit more than half. That is the sell zone. The bears will look to sell around the middle third of the prior bear leg. Buy setups. Here we have a breakout below a trading range, so it's possibly a failed breakout with a good looking bull bar. And here's a second entry bar. If you did not take those trades and you just looked at the chart, you would say, well, that's a reasonable buy, but the bulls are not making money with reasonable buys. Even when there's a pretty good buy signal bar, bull bar closing on its high, bull bar closing on its high, a bull bar closing on its high, the bulls are not making money with stop orders. They're all losers, and that's a sign that the market is probably in a very tight channel and you should only sell. Looking for gaps is always important. When you get a reversal, does it allow limit order bulls to make money? If a bull bought with a limit order at the prior low, he'd get filled here. Does the market pull back enough for him to make money? If he adds on lower, will the pullback go above the breakout point? He could then get out break even on his first buy and then with a profit on his lower buy. He would only take the lower buy if he could enter at least 10 pips below. If these pullbacks do not go above the breakout points, the bulls lose money on the original buy and probably don't make much on their second buy. So I look for gaps. Here's another gap. We have a breakout, tiny bit of overlap here, not going above this low here. Very difficult for the bulls to make money. Another gap. We broke below this low right here, and the pullback did not get above that low. And this pullback also did not get above that low. That means it's very difficult for bulls to make money with limit orders, even if they're scaling in. And that means they should not be buying. It's a tight channel. You should only sell. Again, when I say tight channel, I'm talking about the pullbacks being small. And if the pullbacks are small, very difficult for the bulls to make money. You will lose money looking to buy. When there's a tight channel, only look to sell. A good buy signal bar, a second entry buy for the breakout below this trading range, yet it's a loser. Why am I paying attention to the bulls? Why do I keep talking about buying? It's because if I look at a chart from a bull's perspective and it's impossible for the bulls to make money, that tells me that the channel is tight and I have to be selling. So it's always important to think about what the bulls can do. And if they cannot make money, that tells you that the market has a high probability of going lower. Weak bulls, they're always buying reversals because the risk is small. They buy above the bar, put a stop below. They don't lose much when it hits their stop. And they keep doing that all day long, thinking that the risk is small. But after doing it 4 or 5 times, those small stop losses add up to a pretty big risk. Weak bears, the bears who are afraid to hold on for a swing, they get out above these bull bars. And that's a mistake. Chances are the reversals are going to fail. You'll make a lower high and the trend will continue. Here, we broke to a new low. The bulls got a reversal, but a lower high, and the trend continued. So if a bear who was short got out above this bar, he probably would have a hard time getting short again, and then he would miss the rest of the trend. Rely on your stops. Another thing about every kind of a trend, bull trend, bear trend, they're constantly forming wedges. This is a bear trend. It's constantly going to be forming wedge bottoms. And when one fails, it'll form another one. This wedge is nested. 1 reversal up, 2 reversals up, and the 3rd reversal up has a wedge, 1, 2, 3, and a bull buy signal bar. But it doesn't matter. Any reversal from the wedge is going to be a bear flag, and the trend is going to keep going lower, and it'll form another wedge like this, 1, 2, 3. It does not matter. Here's a wedge, 1, 2, 3. Bear trends are always forming wedge bottoms, but if the legs up in the wedge are small, every reversal attempt is going to be minor, and the trend will continue. A wedge is not a reason enough to take a reversal trade. The legs in the wedge have to be big. You need good buying pressure. Here, the bulls can say, we got a failed double bottom, we're reversing up in a second entry. It doesn't matter. The pullbacks are small. You just keep looking at the trend and say the pullbacks are small, the pullbacks are small, the pullbacks are small. I'm not going to buy unless I see a very major reversal up, and then I'll buy a pullback. So after something like this, then traders might look to buy. But when the pullbacks are small, traders should not be thinking about buying at all. Beginners are eager to trade. They're trying to become traders for a living. Their biggest concern is their accounts are small, and therefore they cannot lose money. They're afraid of their dream of becoming a trader dying. So if they lose enough money, they can no longer trade. And because of that, they focus on risk. The lowest risk trades are buying reversals in bear trends or selling reversals in bull trends, especially tight trends. The signal bars are small. If you buy above, stop below, you're going to lose very little money. However, when you take a trade, you got to be thinking about the trader's equation. It has 3 variables: risk, reward, and probability. And whenever the risk is small, that means the risk-reward ratio is pretty good. When the risk-reward ratio is pretty good, the probability is bad. So these are all low probability trades. You're probably going to lose money. And if you lose it often enough, you end up losing a lot of money. Beginners look at this, they're eager to trade, they feel nervous, the market keeps going down, it can't go down forever, I have to look to buy, the risk is small, they see wedges all the time, and they see bull buy signal bars, and they buy, and they keep losing. That is a sure way to eventually have your account disappear. Tight channel, do not buy. Beginners, they tend to ignore the tightness of the channel, and they come up with reasons to buy because all they can see is risk. They know if they buy a reversal up, the risk is small, and they know eventually there's going to be a big reversal up. So eventually they'll make a lot of money. However, they'll lose so much money while waiting for that big reversal to come. When the reversal comes, either they'll get out early and not make much money from it, or even if they make a lot of money from it, it still will not be bigger than all of the losses that they accumulated prior to getting their win. Do not buy. There are going to be sellers above, just like there were sellers above every other reversal attempt. There will be sellers above here, sellers above here, sellers above here. Do not buy. Remember, a tight bear channel is a bear breakout on a higher time frame chart, and you should only be looking to sell. Here's a 5-minute chart of a very tight bear channel, euro versus the dollar, and this is a 60-minute chart. The same time frame. These bars are these bars. Here's the 60-minute version of it. Now we're getting pullbacks, and some of them are 4 or 5 bars tall, but the channel overall is still very tight. Whenever you have a tight channel, you can look at a higher time frame, and what you usually see is something like this. A very strong bear breakout. Here we have a bear micro channel. It fell about 10 bars without a pullback. And when you look at this, you say, oh my gosh, I want to buy? Of course not. You're saying every reversal attempt is failing. No high is above the high of the prior bar. We're getting consecutive bear bars. We're getting big bear bars. You can only sell. You cannot buy. And when the next higher time frame looks like this, you cannot buy. So when you look at this and you're thinking about buying, and if you're wondering if the channel is too tight, take a look at the 60-minute chart. And if it looks like that, do not buy. only look to sell. A tight channel on one time frame is going to be a breakout on a higher time frame, and you do not want to be buying if the market's in a bear breakout. Again, if you can't tell if it's tight or broad, look at the next higher time frame, 15-minute chart or 60-minute chart. And if you see consecutive big bear bars, a micro channel, no pullbacks, only look to sell. On the 5-minute chart, only look to sell. Here, we're not getting any pullbacks, so it's one big breakout, a bear micro channel. When you look at the 5-minute chart, you keep seeing reversals, and it can be confusing. You're saying, wait a minute, 60-minute chart is in a big breakout, but the 5-minute chart keeps getting reversals. So it's confusing. You're seeing two different things. Traders looking to sell see all these pullbacks, and they're thinking, wow, maybe the shorts are not that high probability. And you're right. When a chart looks like this, selling is a lower probability thing to do than when a chart looks like this. So selling in a channel is a lower probability trade than selling in a breakout. Here's a breakout. However, that does not mean traders should buy. You should not buy when the channel is that tight. The math is still much better for the bears. It looks like it keeps trying to reverse, but it's still a trend. And the reward is big, and the risk is not all that big. If you sell somewhere in the middle of the last bear leg, here's a bear leg, sell somewhere in the middle, the risk is not that big compared to the reward. It's a bear trend, so the probability is 60% that you're going to make money. Sometimes the stop is far, but when you're trading, you always have to use the correct stop. If you're selling for any reason through here, the stop is the most recent major higher low, which is up here. It might be further up than what you want, so the risk might be greater than what you want, but there's still very big reward and still a very good probability, so the math strongly favors selling. When the market's in a tight bear channel, it sometimes has small, tight bull channels, which are bear flags, and the bear trend typically resumes. However, if it pulls back endlessly into a tight bull channel that goes on for 10 or 20 bars, it increases the chances that there could be a bull breakout of that bear flag and the conversion into a bull trend. The market's in a fairly tight bear channel. This is the euro versus the dollar 5-minute chart. We have a tight bull channel going up. We have another small tight bull channel going up, and the market continued down. This is a tight bull channel. You can also call this a fairly tight trading range, which is a horizontal tight channel, and the market broke to the downside. You don't know what the bars to the left look like, but let's assume that this was a bear trend and that this tight trading range is within a bear trend, and this tight bull channel, a wedge bull channel, a wedge bear flag, is also within the bull trend. A tight bull channel within a bear trend is a bear flag. The odds are you're going to get a bear breakout, and traders should look to sell on a stop 1 pip below the low of the prior bar, especially a bear bar. You get filled right here. Once a pullback grows to 10 or more bars, here we have a tight bull channel lasting about 15 bars or so, you have to be thinking that this is different from this and this. Here's a pullback, the bear trend resumed. A pullback into a tight bull channel, the bear trend resumed. Here, the pullback is endless, lasting 15 or more bars. You have to be thinking that possibly the bear trend will not resume. The odds still are that you're going to get trend resumption down. The first reversal up in a bear trend is usually minor, and that means the bear trend usually tries to resume down. And therefore, it's reasonable to sell, especially a second or third entry short below a bear bar like this. However, we have a wedge bottom, 1, 2, 3, and a little bit of a parabolic wedge bottom. That increases the chances that this could be the start of a swing up. Even though it's a minor reversal at first, it's a strong enough minor reversal to make traders wonder if When the trend resumes down, it'll form a major trend reversal. This is a higher low major trend reversal. Once you have a strong breakout with follow-through, a pair of consecutive big bull bars closing on their highs, the market is always in long. Instead of the bull channel becoming a bear flag, it led to a bull trend. It was a bear flag, and we did get a breakout, but the breakout only went to a higher low, and it formed a major trend reversal. At this point, it's always in long, and bulls will look to buy. They'll buy closes, and they'll buy breakouts of bull flags. This minor reversal was strong. It's a tight bull channel that ended up leading to a bull trend. I talk more about this in the videos on major trend reversals, pullbacks and bar counting, and tight channels and micro channels. Here's a 5-minute chart of the dollar versus the Canadian dollar. The market was in a pretty good bull trend. And then look what happened here. We have a tight bear channel. But it's a tight bear channel and a bull trend. And the same here. Another tight bear channel. But it's in a bull trend. The market's still always in long. And therefore, even though it's in a bear channel, a small bear trend, that bear channel is a pullback, which means it's more likely to lead to a resumption of the bull trend than a reversal of the bull trend. Bear channel, bull flag. So this reversal down is minor, which means the bull trend probably will resume. This is different. We have 3 bear bars here. We have 3 bear bars here closing on their lows. I think this is more neutral. Plus, we fell below a relatively major higher low, and therefore, instead of a bull trend at this point, it's probably a trading range. And a trading range means it's neutral. 50% probability bull breakout, 50% probability bear breakout. When you have a bear channel and a bull trend, and the reversal is minor, this is a minor reversal. When you look at this, you're not looking for a bear trend. You're either looking for a bull flag or a trading range. When you have a bear channel and it lasts 10 bars, sometimes 20 bars, the odds still favor a bull breakout rather than a bear breakout. And that means the best the bears can get is either a bull flag, which we got, and a resumption of the bull trend. Here it only lasted 1 bar, or a trading range. The risk of a bear trend at this point is small. The market usually has to transition into a trading range of 20 or more bars before the bears can get a reversal. This trading range lasted about 50 bars. Still neutral, but now we're getting a bear breakout and some follow through, probably going to lead to a measured move down, at least based upon the height of this range. The height of the range, measured move down somewhere around here. At this point, the market is always in short. After this breakout bar and the follow through bar, here's another breakout bar. So it looks like the market is going down with a series of sell climaxes. 5-minute chart, euro versus the dollar. We have a bear breakout and then a pullback. And whenever you have a bear breakout and a pullback and you end up in a trend, you can assume that the trend is going to be a channel. Here, it's almost a trading range. It's not falling down very much at all, but each low is a little bit lower. Each high is a little bit lower as well, and therefore it's a bear channel, and that increases the risk that it's going to go lower. You can sell at any time, just use the appropriate stop above the most recent major lower high. So anywhere in here, the best stop is up here, possibly above this high, but better up here. You can sell at any time and for any reason. The bulls tried to get a reversal up and a high 2, higher low. Instead, we get a strong bear breakout. The market's always in short. That means it's more likely going lower than it is that it's going higher. And if it's always in short, it's usually better only to sell. Beginning to form a channel, and the pullbacks are small, 2 bars, 3 bars, 4 bars, and they're not going up very far, 10 pips, 20 pips. Euro versus the dollar. And we're going lower, lower highs, lower lows. Not falling particularly fast. We're getting some bear breakouts, but nothing all that big. And this entire sell-off is only about 20 pips. We're going down. We're in a channel. We're getting pullbacks, and therefore it's a channel. And if it's not clearly broad, you have to assume it's tight, and therefore you have to trade it like a strong bear trend, like a breakout, which it is on a higher time frame chart. You should only look to sell, and it would be good if you can swing part of your short, because it could fall a lot further than what you think is likely. We're getting good bull bars, and traders are thinking that the bull trend might be reversing. We have a bear bar and a reversal. We have bear bars and a reversal. But the pullback has terrible follow-through. Bull bar, dojis, and a lower high. Bull bar, but a bear bar, a lower high. Channels are constantly trying to reverse. They're constantly trying to bottom, but they're still short unless they go above the top of a most recent major lower high. And therefore, if you're trading them, you have to be aware that they're always going to be reversing. They're always going to be forming bottoms, but they're still always in short. And the odds are bears will sell the middle of the most recent leg down. Here's a leg down. The middle is around here. Even though the bull's got a reversal up, that's where the bears will sell. You rely on your stop and you take the short. One way to do it is when the market reverses up about halfway through the prior bear leg, you sell on a stop below a bear bar. Here we have a double top. You could sell below that bar. Here we have two legs up, one pullback, and then two. Sell below that bar. A low too short, a lower high, and a bear trend. And if you take this short, stop is above the top of the most recent major lower high, a breakout to a new low. Tight channel. The pullbacks are not all that far. There are a lot of bars, but not all that far. A lot of traders will not look at this and see a bear trend. They'll say, it's a weak bear trend. It's probably a bear leg in a trading range, and we'll probably get a bull leg in the trading range. However, it's a small pullback bear trend. Look at this breakout pullback and look at the breakout point gap. And the same here, very little overlap. Very difficult for bulls to make money. And therefore, the trend is probably stronger than what you think, which means it's probably going to result in lower prices. And as more and more bulls gave up after losing with repeated attempts to buy, the market started to accelerate down. Bulls became less willing to buy. Bulls became more willing to sell. 5-minute chart, dollar versus the Japanese yen. You have personal built-in radar. Your emotions tell you what to do. If you look at a chart and say to you, oh, I don't know, it doesn't look all that strong. Where are the consecutive big bear trend bars? There's not much energy on the downside. We keep getting reversals. Maybe I'll sell, but I want a higher pullback. And then when you're hoping, before you get your higher pullback, it goes down again. You hope for a higher pullback so you can sell higher, less risk, it goes down again. Whenever you look at a chart and you're desperately hoping for a better looking sell setup, a better looking bear flag and pullback so you can sell with smaller risk, that is one sign that the market's in a strong bear trend and you have to sell for any reason. You know where the stop has to be at any point. When you're down here, the stop is up here. It does not matter where you sell in here, the stop is up here until you get another strong breakout, and then you can lower the stop here. The good stops are obvious. And if you're not sure what stop to use the highest one, the furthest one up. It increases your risk, but it increases the probability of making money. Also, if it does reverse up, most traders will exit before their stop gets hit if they're using a wide stop. These are all reasonable stops. At this point, the stop is up here. Once you have a new breakout to a new low, somewhere down here, the stop is here. Strong breakout, move the stop to the top of the most recent lower high. This becomes a major lower high. And if the market is here and you sold here, or here, or here, or here, or if you sold here, or if you sold here, at this point, no matter where you sold, the stop is here. You keep trailing the stop. After each breakout to a new low, and the breakout's reasonably strong, you lower the stop to above the top of the most recent major lower high. Whenever the market's in a trend, a bull trend, it's always going to feel like the market's making you buy too high because the market is always at the high. Whenever the market's in a bear trend, especially a tight bear channel or a breakout, if you're selling, you're always selling near the low. And it always feels like you're selling too low. You want to sell higher, so your risk is less. It always feels like the trend is not strong. You can get a reversal anytime. But whenever the channel is tight like this, the reversals are all going to be minor. They're all going to fail. 70 or 80% chance that every reversal up is going to fail. Whenever you have that feeling, if you're flat and you look at this and you say, well, it might bottom, it doesn't matter. Take the short, use the stop. Once you get the breakout, use a new stop. But you have to sell at least a small position as soon as you start to feel like the market is forcing you to sell lower than you want and you're hoping for a pullback. That's your radar telling you that you have to get short. If you have several choices for a stop, let's say you sell here, this is too tight. We don't yet have a strong bear breakout. Then you have choices, a stop here or up here, and you can't decide which one to use. Use a middle one, right? Use this one or that one. For example, you could use this one. This is a reasonable one if you sold here. Again, 5-minute chart, dollar versus the Japanese yen. Even if you sell at the lowest price of the trend, at this point, this is the lowest price of the trend, the probability of losing money is small if you use the appropriate stop. The odds are the market will still continue lower and reversals will be minor, forming bear flags, resulting in a resumption of the bear trend. You have to be patient. Sometimes it takes a lot of bars to get down as far as you want it to go, but the odds are very high that it will get there. Very unlikely to get an opposite trend unless there's either a strong bull breakout, a very strong minor reversal. If you get a very strong minor reversal, then if the trend resumes, the next reversal might be major. You might get a major trend reversal. And it's unlikely that you're going to get even a strong minor reversal without the market first starting to go sideways and form some buying pressure first. So the risk of losing money is small until after you've had a very strong minor reversal. Then the market's probably evolving into a trading range. And at that point, it may form a major trend reversal. Tight channel, very strong trend. So the risk of reversal is small. Every reversal is going to be minor. A bear flag may be a small trading range. And if it is a trading range, the market usually gives you an opportunity to get out without a loss if you decide the trend is no longer strong. Again, even if you sold at the absolute worst price at the low of the day or the low of the session, 70% chance the first reversal up will come back to your entry price and allow you to get out break even. 70% chance actually that you'll make money even selling at the low. If you sell at this close, you put a stop up there. Most traders would not sell here. It's a bigger bar, it's a climax, and therefore it's probably the start of a pullback. But even if you did sell that worst price of the session so far, the best the bulls can reasonably hope to get is a minor reversal and maybe a trading range. And therefore you hold short, rely on your stop, and then just patiently wait for the market to go further down so you can make money. If you took this sell and you see these reversal attempts, it's still always in short, and that means you believe the market's going lower. Sometimes late in the session, the bears will take profits and you can get a deeper pullback, but it's still probably going to be, at best, a bull leg in a trading range and not a bull trend. At the end of the session, often the market evolves into a tight trading range, but if you shorted, you can get out with a small profit. If it starts to form a trading range, you took the short based on the premise that it was a tight bear channel. And if it's starting to convert into a trading range, it's reasonable to take profits, get out, even though it might fall further. For example, we have a decent bull bar here after a sell climax, a good bull bar here. Now we have a double bottom. Remember, reversals either form bear flags or trading ranges. And late in the session, you're going to be looking for reasons to take profits. And this is reasonable. The sell climax and a double bottom and a couple good bull bars. Probably not much more left to the session. Again, a wedge, to me, who cares, right? Chances are you're not going to get much of a reversal when the channel is tight. Every wedge is a channel, and if the channel is a tight wedge, it's probably not going to go up that far. You're not looking to buy here. You're simply looking to exit a short. You'll exit a short when there's a buy reversal that is often not strong enough to go long. You're buying back your short. You need less of a reason of a reversal than you do if you're looking to buy to go long. Another breakout to a new low, strong breakout. This is then a major lower high. It's reasonable if you put your stop here, and you can hold on short until you're done trading or until the end of the session. Look at this. What do you notice about this tight channel? This high is below that high. This high is below that high. Every high is below the prior bar's high for 15 bars. So it's a micro channel, and it's a breakout, even though it does not have consecutive big bear trend bars. And on a higher time frame chart, this is a breakout. Even if you sell at the bottom of a breakout, the probability is high that you'll make money. The probability of losing money is low. On a 15-minute chart, this would be a series of strong bear bars closing on their lows, and therefore the first pullback is minor, and you're probably going to fall for at least a measured move down based upon the height of that channel. To me, I would view this as a breakout, and if you sold here, there's your risk. That's how much your risk is. Probability very high that we're going lower. Risk is relatively big. Instead, if you sold here after a breakout to a new low with a decent breakout, reasonably strong, you could put a stop up here. Your risk is less, but now we're in a channel phase because we had a pullback, and that means the probability of lower prices is less at this instant than it was at this instant. Lower probability often means better risk reward. Here, the risk is slightly less than if you sold here, and the reward is about the same. I began by talking about what a tight bear channel is. If it's hard to make money buying, you should only look to sell. A tight bear channel is a breakout on a higher time frame chart, and you should only look to sell. Whenever the market's in a tight bear channel, it'll repeatedly get small bull tight channels, and they're bear flags. However, if one of those bull channels grows endlessly into 10 or 20 bars, traders have to be thinking that there might be a bull breakout above the bear flag and the conversion of a bear trend into a bull trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading tight bear channels.